If you run a small or medium business, you may already know this. Growth takes capital, cash flow fluctuates, and opportunities don't wait. Business finance isn't just about getting approved for a loan, it's about the structure. Today, I'm going to break down why businesses need funding, the difference between growth finance and working capital, asset finance options, and how to structure properly. Because when finance is structured right, it accelerates your business. When it's structured wrong, it can create stress. So let's break it down. Let's start with the foundation. Finance is about structure, not approval. Most business owners think, I just need the money. But the real question is, what is the money for? There are four core drivers: growth and expansion, managing time gaps in cash flow, building infrastructure, seizing opportunities quickly. Before choosing a loan product, you need clarity on the purpose. That's step one. Every business hits an inflection point. You've proven your model and now you want to scale. That could mean opening a new location, adding new product lines, buying a competitor, or even investing into automation or systems. Growth requires capital upfront before revenue increases, and the ability to act quickly often determines whether you win or lose the opportunity. Growth finance is long term. It should be structured to support expansion, not choke your cash flow. When it comes to funding growth, business term loans are common. They provide predictable repayments. The stability does matter. You may choose secured or unsecured options depending on trading history, the strength of your financials, available collateral. Secured loans often offer better rates. But here's the key: repayments must align with your revenue projections. If the structure doesn't match your growth timeline, you create pressure. Growth funding should be supportive of expansion, not create strain. Now let's talk about something different. Profit and cash flow are not the same. You can be profitable on paper and still run into cash flow pressure. Common causes: customers might be paying anywhere between 30 to 90 days, seasonal supplier expenses, payroll obligations that don't really wait, tax payments that hit in large chunks. Now, this is where working capital solutions come in. These are short-term tools, not expansion tools. They will help you to smooth timing mismatches. Let me give you a simple example. A builder wins a $2 million project. Great margins, looks fantastic on paper, but here's what happens. Day 0, materials are ordered, some contractors are engaged. Cash starts going out immediately. Day 30, $500,000 in supply bills are due, no client payment yet. Day 60, first progress payment arrives, but more work has already been completed. More costs have gone out. Result: the project is profitable, but liquidity is tight. Now, this is the difference between profit and cash flow timing, and this is where many strong businesses get caught. Working capital facilities are designed specifically for timing gaps. So, for example, a business overdraft. You draw what you need, pay interest only on what you use. It is flexible as well as revolving. Or you might choose working capital loans, short-term structured facilities that bridge the gap between paying suppliers and receiving customer payments. These are not for buying buildings. They are not for 5-year expansion plans. They are very common just to maintain the momentum. There's a big difference. Now let's move into asset finance. Physical assets drive operational capacity: machinery, vehicles, technology systems, or even warehouse improvements. These investments increase productivity, but they also require capital upfront. Draining your working capital to buy assets outright can create some risk. That's why asset finance exists. It preserves cash while allowing you to use productive assets immediately. There are several common asset finance structures. Number one is a shuttle mortgage. You own the asset from day one, you claim depreciation, and you repay it over time. Secondly is a finance lease. The lender retains the ownership, you use the assets, payments are treated as expenses. Hire purchases. Ownership transfers at the end of the term. For commercial property, you're typically looking at longer term loans, let's say up to 25 to 30 years. And here's the key principle: match the funding structure to the asset life. Don't finance a 3-year vehicle over 10 years. And don't use short-term overdrafts to fund long-term assets. That's where problems can start. This is where most mistakes happen. Misalignment. Using working capital facilities for expansion, using short terms for long-term assets, or overstretching repayments. The correct structure matches the asset life, aligns with cash flow cycles, minimizes unnecessary interest, and supports your strategic objectives. At CKC Lending, we don't just arrange loans, we design finance structures around your business. where you are today, where you are heading, and how cash actually moves in your operation. Because finance should accelerate growth, not create hidden risk for you. So if you're expanding, managing cash flow, or acquiring assets, let's look at it properly. The structure does matter. And when it's done right, finance becomes a strategic advantage. Now, if this video helped you understand business finance more clearly, subscribe for more practical breakdowns. And if you want to discuss your situation, simply reach out. Thanks again for tuning in, and I'll see you in the next video.